Good afternoon, listener. This is Jonathan Davis. This is the Booms and Bust Show. A very warm welcome to the show. I'm recording this on Wednesday, the 8th of March in the afternoon. I've just listened to that numpty Philip Hammond do his annual party political broadcast, budget, which, as usual, doesn't get to the heart of any problem. These things tinker round the edges. Today, we will, of course, talk about the budget and some of the features that I have found to be particularly wanting. We'll, of course, talk markets and economics. I want to touch on UK house prices. There's some interesting data there which is worth looking at, and of course we'll have the quote of the day, although actually it might be the scary chart of the week for me to discuss. Before all that, to remind you, I did the first Booms and Bust show way back, I think it was a month ago on the 8th of February. I thought it would take a week or two to get onto the podcast hosting services. It took a month. It was absolutely ages. But we finally got there. And I want to thank every one of you who was kind enough to like it, to retweet it. A number of you even retweeted it a number of times. It's on iTunes now, finally, since yesterday, the 7th of March. So it's absolutely fabulous, the response that we've had from the first podcast. Once again, thank you very much indeed. I want to remind you that if you want to have a chat with me about these things, just either tweet me at Jonathan Davis, where remember, the O is a 0. That's Jonathan Davis, where the O is a 0. Or email me at jdavis@jonathandaviswm.com. jdavis@wm.com. There's a lot to talk about today. Let us indeed start with economics. And a couple of very interesting economic stats have come out. The Federal Reserve of the United States, you may know, is not like the UK's Bank of England, the central bank, where you've got the central office in London, in Threadneedle Street, and what they say goes. It's the Federal Reserve of the United States, and thus they have a dozen regional offices dotted around the states, in theory reflecting the distribution of the economy in the United States. Now, everyone knows that the New York Fed, which is in effect the Federal Reserve of Wall Street, is by far the most powerful. But ultimately, it's the Federal Open Market Committee, which meets in the Eccles Building in Washington, D.C., that sets interest rates. The New York Fed, in essence, prints the money and bails out the bankers all the blooming time. Ugh! Mr. Angry of Hertfordshire here. And the Atlanta Fed produces some serious economic statistics, and indeed just this week it produced the forecast, which is the first forecast for Q1 GDP growth in the US. They've forecasted it at 1.3%, the real GDP, that's the inflation-adjusted GDP. Why is that of interest? Well, of course, 1.3% on an annualized basis is what they're talking about, is the running rate for quarter one. It's not the final figure. It's the forecast for what Q1 will be, the running rate for the economy for the year. 1.3% is, of course, extremely lackluster. Think about it. Over the last, 8 years, the US has done tens of trillions of dollars of so-called stimulus. It's had zero interest rates in effect all that time. And this is all they get. 1.3% growth. It's absolutely dire. Worse than that, only 3 months ago, the Atlanta Fed were suggesting 3.4% for Q1 annualized running rate. It's a massive reduction from one quarter to the next. So clearly, the official bodies are worried about the US economy. Having said that, though, we don't know if that's the Trump factor. In other words, the bureaucrats hate Trump, obviously. So are they deliberately giving very low rates of return of growth estimates? I would suggest not, because on the other hand, you've got the Washington Fed, the Federal Open Market Committee, which meets next Wednesday to decide on the interest rate for the US, for the base rate. And the market has read the ruins on this, and they have got the Fed futures at 85%. This is the market price, the market bet in essence, 85%. There is going to be a rate hike next Wednesday, the 15th of March. So, interestingly, you've got one side of the Fed saying the economy is being downgraded. You've got the other side of the Fed, which, of course, you're talking about Janet Yellen and all the so-called doves, the people who would have minus 50% interest rates and printing $10 billion trillion a day if they could get away with it. You've got the Federal Open Market Committee is full of people who hate raising interest rates. They've only done it twice in the last 10 years. And yet, the last time they did it was just in December there. And they've basically said, to all intents and purposes, that they're going to raise again in a week's time. They had only raised twice in 10 years, and now they're going to raise twice in 3 months? In other words, the Fed is hugely political. They are get Trump at all costs. To hell with the economy. The economy is being downgraded by one side of the Fed because they are actually looking at what's happening in the economy, and the other side of the Fed is saying, we pretend we're not political, we're entirely political, we're going to raise interest rates, even though we said we're going to look at the economic statistics. They don't give a flying fig about the economic statistics. All they care about is making it as difficult as possible for President Trump. Can you believe it? They're dealing with the global economy based upon their hatred of a guy who loves free speech. It's that ugly, listener. On the other side of the pond, the United Kingdom, we've just had the budget. I'm not going to go into detail on the budget right now. I will do in a few minutes. But what is notable is that the Office for Budget Responsibility back in November was saying 1.3% growth for the United Kingdom. They're now saying over 2% 3 months later. So Brexit, apparently, of course, was going to take us all to hell in a handcart. This was stated by the OBR, by the IMF, by the World Bank, by the Bank of England, by Uncle Tom Cobley of the establishment, but the reality is very different. Well, quelle surprise. On the market side, we should really probably only focus on one instrument, the US dollar. Now, when I tweet or publish this podcast, I'm going to publish alongside it or attached to the tweet charts which will refer to what I'm talking about in this podcast. And what you'll see there, if you look at the chart of the US dollar, which I'll be posting, you'll see that with a bit of gyration, the dollar index, which is the dollar against a basket of currencies, the euro, the Canadian dollar, the Swiss franc, the pound, the yen, the dollar index is more or less where it was 2 years ago. On an index 2 years ago, it was about 100, 102. Today, it's about 100, 102. It's had a bit of gyration in the last 2 years, but essentially it's where it was. You will note there's a horizontal line at about the 99-100 level, and the market, the dollar, rose above this in recent weeks, and indeed the dollar has been strong in the relatively short term. And this has had a major negative effect on commodities. I talked a lot about commodities, particularly gold miners, the oil price, in the last podcast. And these commodities have been finding it difficult. They've had quite sizable falls in prices, in fact, since a few weeks ago, since the dollar broke up above what we call the resistance line. When a trend is rising, it goes up to a resistance line and it can bounce back down off it, or it can break through it. And just for your reference, when a trend is down, it goes down towards a support line, and similarly, it can break down through it, or it can bounce up off the support line. So the dollar did break up through the resistance at 99-100, and it's still above it. And there's no question commodities are in trouble here. There's no question. We need to note that. And if commodities are falling, this is the opposite of inflationary. It's deflationary. Falling inflation. Somewhat contrary to what I said in my last podcast. Now you'll be thinking, this is very quick to change your mind, JD. The reality is, remember, I made that podcast literally a month ago. And although I want to do podcasts about weekly, sometimes more often, sometimes less often, the very first one, it took a lot of time to get into the hosting systems and iTunes and whatever, but we're there now. So that was a month ago, and in the last month, the dollar has largely been strong and commodities have been weak. So we've got to note that, and it's very important that we don't have a permanent bias to any asset class, but instead we go with the flow. And the flow is what the markets are doing, not what we think. What we think is irrelevant. We must act based upon what we see. Shares, stock prices appear to be in a global uptrend, particularly outside of the US, although including the US as well. But globally, stocks have been an absolute tear. And if you look at the US markets, which are the daddies of them all, there's no question, you can tell a lot about the world if you look at the US stock market often, they have had a period of what we call consolidation. In other words, they've been bumbling along a certain level. I have no particular thought as to which direction shares are going to go. I am seeing hesitation and indeed pullbacks in certain sectors. In other sectors, there's still some strength. So it's just a look and watch right now. It's not a this is happening or that's happening, because actually nothing is happening. What I will say, however, is global and particularly US stocks then have been on a tear since, well, as long ago as February last year. That's over a year now. So, realistically, global stocks are due a pause. Doesn't mean they have to have one, but they are due one. That's a fair comment. If they have one, I wouldn't expect it to be the big 2008 style crash. On the contrary, I think it's more likely to be something of the order of a 5 to 15% correction. In other words, a normal correction in a bull market. And I've been saying that there are very strong indications that the weakness in US shares between the second half of 2014 and the first half of 2016 could well actually have been a bear market in disguise. The end of the prior cycle, which started either 2009 or 2011 in stocks, depending on your point of view. It was such a long period, nearly 2 years, of the US market doing nothing, indeed going backwards, that you could almost say that it was a bear market in disguise. Thus, the rally which started in February of last year, when I remind you there was massive bearishness all over the world. You'll remember RBS came out with the apocryphal "sell everything" was their huge headline. Bank after bank was saying, we're going to hell in a handcart. This is it, guys. And as usual, they were totally and utterly wrong. I suspect they were doing what they always do. They were getting their clients, their pension fund clients, to sell while they could buy. I mean, certainly you saw Jamie Dimon, the chief executive officer of the largest investment bank in the world, JP Morgan. You saw him make a big announcement early last year of buying $28 million in JP Morgan. He's more than doubled his money. More than doubled his money. And this is when everyone else was selling. Isn't that interesting? Plus ça change, le plus la même chose. The more things change, the more things stay the same. If there is a correction in the stock market, then you can reasonably expect government bonds to do well in the period of the stock market correction. Now, I said last time I would talk a little bit more about government bonds. Let's do that just now. Government bond. Government is obvious. Bond. It's just a jargon for a loan. So you get government bonds, you get corporate bonds, lending to government, lending to companies. Government bond in the UK, more jargon, they're called gilts. In Germany, it's bunds. In America, it's treasuries, US treasuries. You're literally lending money to the government. As you well know, the government is the biggest borrower that there is. And they borrow by issuing certificates of government bonds. And those bonds will have durations of between 1 week, 1 month, a year, 2 years, 5 years, 10 years, 30 years. Some government bonds are for 50 or 100 years. Indeed, in time gone by, there were even non-redeemable government bonds, believe it or not, where you would lend the money to the government and they would never pay you back. They would merely pay you interest forever or for as long as you hold the certificate. And clearly what that means is you can sell the bond to someone else and then they receive the interest. But normally there is a fixed duration for the government bond. Let's talk about 20-year government bonds. Again, more language, long-dated government bonds. They tend to be long-dated when they're above 10 years or 15 years, depending on your point of view. 20 plus years is long-dated government bonds. And the idea is that you lend money to the government for a stated interest rate, which the government pays you for 20 years, and then in 20 years' time pays you the loan back. Now, think about this. If we are in an era of inflation, which, I'm not relating it to the real world right now, just consider we're in an era of inflation. You've loaned £1,000 to the government, and in 20 years' time you get your £1,000 back, but as you've immediately surmised, it's not worth what the original £1,000 was worth. Because of inflation, the purchasing power has dwindled away due to inflation. So naturally, you need to be compensated for that reduction in spending power in the form of high interest rates. So if you were to lend over the next 20 years to the government in a time of rising inflation, you better make sure you get a very good interest rate to balance off the reduction in the capital value in real terms, in spending power terms, that you will achieve over the 20 years. On the other hand, if you're in an era of falling inflation, then that £1,000 that you lend to the government today in 20 years is actually going to be worth more. Thus, the government expects to pay you a far lower interest rate in the knowledge or the expectation that your £1,000, the refund that you get in 20 years, will be worth more. Thus, when inflation is falling, interest rates are falling, and when inflation is rising, interest rates are rising. At the moment, if you lend to the government over a 20-year period, the interest rate is give or take 3 or 3.5%. And, the investor, the lender, has to work out, is the inflation that we have, which is about 2.5%, as you know, is that sufficiently compensated for by a slightly higher than inflation interest rate? Well, I would suggest to you, if over the next 20 years, we have only 2.5% inflation, then clearly a 3.5% interest rate will compensate you because you're getting more than the inflation. If, however, inflation was to take off and go to 5%, go to 10%, and you're holding a certificate which entitles you to just 3% interest, well, you made a bad investment. You made a bad loan. So therefore you have to dump it. You have to sell it to the next guy who, for whatever reason, wants to buy it. But I can assure you, he's not going to pay you £1,000 for the privilege. He'll pay you, for simplicity, £900. In the knowledge that in 20 years' time, he will receive £1,000. So not only will he have a capital gain, but he'll also have the interest on £900. So, that's how the bond market works. And how it relates to stocks and shares? Well, if stocks are falling, it's because largely the economy is not doing so well. Investors believe that corporate profits are going to fall, so they sell shares. And if corporate profits are going to fall, it's likely because the economy is falling, so you buy government bonds. You buy government bonds because inflation is likely to fall. And when inflation falls, the price of your government bond rises. So, as I say, in a nutshell, I don't know what's going to happen to stocks and shares right now, to company shares right now. They have risen for over a year. They're due a 5, 10, 15% pullback. Whether or not we get one, I don't know. But if they do pull back, then we could probably expect to see government bond prices rise. However, I would be very, very surprised indeed if it's the end of the bull market in shares. Indeed, it seems to me that 2016 could well be the start of a multi-year bull market. Let us indeed move to the budget. And there were some corkers by cronyist Philip Hammond, who, I don't know if you know, he used to be a property company director. He probably is, for all I know. I gather he transferred a lot of his assets into his wife's name on becoming a senior member of the cabinet. I don't know the exact reality there, but I believe that's the case. That's what I certainly picked up on Twitter. And of course he starts off, because this guy was a major Brim owner. He was a massive Remain guy. And he starts off the budget by pretending that Brexit is material, that everything is contingent in the economy on a smooth Brexit. I think Brexit's got nothing to do with it. Now, I know there are some listeners who are going to say, well, of course there's going to be changes in the economy if we leave the single market and whatever. Well, yes, but my view is that the global economy is what's going to determine the strength or otherwise of the UK economy and indeed of global markets, whether it's gold or government bonds or stocks. It's the global economy. It's not Brexit. However, typical of a Remainer to say that. He's not a continuing Remainer. After all, he's hand in glove with the Prime Minister, who is very clearly now a Brexiter. And she is the prime Brexiter, and she is the lady who's making it happen. And indeed, who knows, maybe by my next podcast, we might have initiated Article 50, or maybe it'll be the podcast after that. Let's look at some highlights from the budget. The UK has admitted to 1.7 trillion of debt. 1,700 billion pounds of debt. £62,000 per household, and that doesn't include, of course, household debts. Already our illustrious government, because of promises that they've made over the decades, our government is spending, how much do you think the UK government, at the lowest interest rates in human history, how much do you imagine the UK government is spending just on interest? Not repaying the debt, just on interest. So that the bankers who have loaned that money can run all the way to the bank. They're laughing their faces off. Do you think our government pays 30 billion pounds a year in interest? 40 billion pounds a year on interest? 50 billion pounds a year on interest. I'll give you a clue. The total spending in the UK on defence and policing is nearly 50 billion pounds a year. The UK government spends more than we spend on defence and policing combined, just on interest, 50 billion pounds a year. And that's with the lowest interest rates in history, listener. Get this. If, in the fullness of time, interest rates were to rise, I can tell you that rapidly we would go from 50 billion pounds a year to 100 billion pounds a year. It stands to reason. If the average interest rate that our government is paying is about 3%, 2.5%, and it goes to 5%, we're going to double the interest rate, the interest spend. You think we've had cuts? You ain't seen nothing yet. Nothing. And this cronyist, Marxist Hammond says that the only responsible course is continuing a deficit reduction plan. A deficit reduction plan? Do you know what that means? It means that instead of borrowing 50 billion pounds a year, which is what he's spending this year, in 5 years' time, he'll borrow 20 billion pounds in the year. A deficit reduction plan is not reducing debt. It's just reducing how much you're borrowing. Mr. Hammond, I have news for you, matey. The only responsible course is a debt reduction plan, not a borrowing reduction plan. But it sounds good, doesn't it? Politicians. Meh. What else did that Marxist talk about? Oh yeah, what do Marxists love to do? They love to raise taxes, don't they? So, if you're self-employed, in other words, you're not cadging off the state, you're actually trying to make a buck. Or if you've got a limited company and doing the exact same thing as the self-employed, it's just under a different tax system, your taxes are going up. If you have an office or a warehouse or a shop or a manufacturing facility, your business rates are going up. Listener, the wealth creators of our economy are seeing their taxes rise. This is apparently meant to be a low-tax country, because income tax, you don't pay tax until you earn 12,500, and it's only, 19-20% on your income above that, and then it's 40% and so on. And corporation tax is coming down. Low-tax country, pull the other one. As usual, they're raising the taxes on the silent minority And worst of all, they're raising the taxes. They're making it harder for the true wealth creators, wealth generators of society. Not the public sector, the spenders, not the large companies, or what I call the civil service of the private sector, but no, the small companies, the small owners of businesses. If 1 million of us was to take on one extra employee, that's 1 million off the dole queue. But you never hear of small businesses taking on 1 or 2 people. But I'll tell you what you do hear of almost every week. Large international concern closing this or that facility. 500 job losses, 1,000 job losses, globally 10,000 job losses. And what are they doing? They're helping the big multinationals. They're helping the public sector to the detriment of the real wealth generators of society. And they call themselves free market capitalists. Nothing could be further from the truth. What else did this guy say? A well-functioning market economy is best for people's security. A market economy? Are you pretending, Philip Hammond and the Conservative Party, are you pretending to be free market capitalists? You supported the bailouts of the banks. You've been printing money hand over fist since 2010, when the Conservatives have been more or less in charge. You're the ones that have had 0 interest rates. It was Osborne that brought in Carnage, as I call him, Mark Carney, to be the governor of the Bank of England. The guy who told us, in no uncertain terms, that Britain would go down the pan the day after the referendum if we voted to exit. The guy who, for absolutely no reason at all, cut the interest rate a few months ago when the economy was doing well. This is the Conservative Party, so-called free market capitalists, who are borrowing from our children, from our grandchildren, so that basically they can stay in power. And I'm wondering if I can find, while I'm speaking, the great quote from Thomas Sowell. I doubt I'll be able to, but you know what? I'm going to give it I go. Do you know what? I have found it. Can you believe it? It's coming up. No one will really understand politics until they understand that politicians are not trying to solve our problems. They are trying to solve their own problems, of which getting elected and re-elected are number 1 and number 2. Whatever is number 3 is far behind. Thomas Sowell, economist, greatest economist, political thinker on the planet. Free market capitalists. He says, Hammond, our job is to make our young people safe and prosper. So tell me, Mr. Hammond, why do you continue to bail out failed banks? Why do you print money under this so-called quantitative easing nonsense? Why do you continue with help to buy for new properties? Or as I call it, help to sell? It does nothing about helping young folk. All it does is keep prices high. End help to buy. Ban money printing. And I tell you, house prices would fall. That's the way to help young people not by keeping house prices high. So the budget, as I say, it was just a political broadcast, and they always are. Whether it's red or blue, in that box, it's just tinkering at the edges, and it's to get them elected and re-elected. That's all it's about. Pardon me. And, you know, it was basically a pretty balanced budget. It didn't give away much. It didn't take much, except from the people that it shouldn't have taken from. Why? So that in the 2 years up to 2020 election, he's going to be a big spender. That's what party politicians do in a 5-year fixed term or even unfixed term of a government. They play around with the system. The last thing they're going to do is actually repay the debt. This is what's incredibly ugly. So I'd be interested in your thoughts on the budget, following those that I've just made. Do tweet me, do email me, and we'll have a conversation in effect over the airwaves and through the Twitter sphere. Let's look at UK house prices. And I've had some great tweets. Thank you very much, those who have tweeted me. This is one from a guy called Chris Jennings. His Twitter feed is @_Chris Jennings. And he sent a few tweets. I'm going to read all of them out. To what extent is monetary policy to blame for unaffordable housing, aka the housing crisis? According to the Institute of Financial Studies, the UK has more residential floor space per head than 20 years ago, and yet prices have risen. Why? If we've got high and rising house prices, if that's so popular, why aren't we demolishing houses instead of building them? Very good point. Is there a solution to the problem of unaffordable housing that doesn't entail falling house prices? And finally, why are those who already own homes continually protected to the detriment of those who don't? Well, in answer to some of those questions, Thomas Sowell gave you the answer. Politicians see rising house prices as vote winners. So that's why, since Gordon Brown, they've supported house prices. They've boosted house prices. No, it wasn't John Major, and no, it wasn't Maggie Thatcher. No, it wasn't. In Brown's time, in the space of 7 years, he trebled household debt. Because he knew from 1997 the way to an electorate's heart was through its house price. So he got people borrowing like crazy, and he got the banks lending like crazy. And then, of course, Cameron Osborne continued it, and May Hammond continue it. And I can assure you, if Corbyn MacDonald somehow, which is, of course is extremely unlikely, if they were to gain power, they would continue it too. So-called socialists, they're Marxists, and the other side are cronyists, which is simply on a spectrum of socialism. And that's why I call, bit tongue-in-cheek, Philip Hammond a Marxist. But I say it's just a spectrum of socialism. Is there a solution to the problem of unaffordable housing that doesn't entail falling house prices? Well, you know, I keep reading the Institute of Economic Affairs at IEA, and they say time and time again, the answer is get rid of the planning laws and build hundreds of thousands, if not millions, of homes. I can't believe these guys are so selfish. Don't they realise that we have one of the most beautiful countries in the world. We have a green and pleasant land. And in an experiment of getting rid of all planning laws, and we concreted over the whole country, even that would not reduce house prices. But what it would result in is immigration of a level which you can't even imagine. And by the way, I am not anti-immigration. But you should know that if we build 1 million homes, we're going to have hundreds of thousands of immigrants. If we build 10 million homes, we're going to have millions of immigrants. You may think it's a good or a bad thing. I'm just telling you what would happen. And more importantly than that, we would leave a legacy to our great-grandchildren, where you and I live in a green and pleasant land, and we're never far away from the countryside. Even if we live in deepest, darkest London, we're out in the countryside within an hour. We can go to a park within 10 minutes. But if we concrete the whole thing over, we will leave the most god-awful dystopian future to those 2 or 3 generations who come after us. That's why I call the IEA selfish. The other thing is, building houses has never reduced house prices. Now, Economics 101, of course, says more supply, prices fall. Well, yes, it does. The thing is, though, if you've also got a supply of credit, in other words, easy lending, you will never get falling house prices. And you cannot point to me a single country in the world where you had high house prices and, you had high house building and falling house prices. Because at the same as high house building, you also had easy lending. It's only when you had the global credit crunch in 2008 that you got house price crashes. You got house price crash in America, in Ireland, in Spain. They had high house building, but you didn't get a house price crash until you had a credit crunch. You didn't even have house price crashes in Canada, in China, in Australia, in Britain. You didn't have a house price crash because the lending got going again, or it didn't even stop. So unless and until we stop bailing out the banks will be allowed to lend whatever they want, knowing full well that if ever they go bust, we'll bail them out again. They will continue to lend whatever they want. Thus, house prices will always rise. Help to Buy is lending from the state. It's Marxist. Another reason why house prices won't fall. You end easy lending, you will end house prices. The outlook for house prices is, well, your guess is as good as mine. I would say to you, it's dependent upon whether or not there's an economic collapse. If there's an economic collapse, there will be a short-term crash in prices, 15-20%. And then beyond that, well, it depends what the policymakers do. What I would say is, I actually cannot see house prices any higher in 20 years than today. And on another podcast, I'll explore with you why. What I can tell you is data we've just had about Foxtons, the London-based estate agent. In 2016, they saw their revenue from selling houses fall a quarter, and we saw their revenue from lettings flat or down 1%. That in itself is interesting because there's been a big rise in the lettings market. and they haven't been able to take part in it. So there's no question that London has been hit hard for sales of properties. Is that symptomatic of what's going on generally? Who knows? But I'm just relaying you what actually did happen to Foxtons, which to me is a very strong indication of what is happening in the market. I'm actually going to start wrapping up there. I've got a kind of a quote of the day. Well, it's less a quote of the day, and it's a scary chart of the day. And it comes from Ron Sturferle. That is spelt RONSTOEFERLE, at Ron Sturferle. And he's a markets participant. He's a chartered markets technician. And he shows, and it's very similar between the US and the UK, that at the moment in the US, last year, the US government spent 6% on interest of all their spending. 6%. Incidentally, the biggest spending was the biggest individual spending was actually on major health programs. Well, there's a surprise, given their ridiculous healthcare system. 26% of the economy went on healthcare. The projection by the government itself, the Congressional Budget Office, 30 years from now, assuming interest rates never rise, is that the percent of spending just on interest will rise over the next 30 years from 6% of spending to 21% of total spending. That means, obviously, there has to be huge cuts elsewhere. This is why I say to you, listener, you ain't seen nothing yet. Because even if interest rates don't rise over the next generation, the cuts will be beyond belief. And then you have to ask yourself, what if interest rates do rise? It's beyond frightening. What's that movie that Matt Damon was in, that science fiction thing, Elysium? I saw it on telly a few months ago. It's an okay film. It's got Jodie Foster, is that her name? A massive anti-Trumpist, another blooming lefty liberal who, multi-millionaire, double Oscar winner, doesn't know what the hell she's talking about. She was in it as well. What's interesting about that is it's set in the late, I think it's set in the late 21st century. It might be the 22nd. I'm not quite sure. Can't remember. And all you see is these massive, 100 million populated favelas. Like you see across Latin America, abject poverty, millions and millions of folks for street after street after street. And, in the long-term future, these conurbations are 50, 100 million fold. And I just can't get out of my head. This is what the long term looks like for the average person in the West in 2 or 3 generations. My God, I hope it's not. And the only way it's not going to happen is if we bring back capitalism. On that note, I thank you for listening. I really enjoy seeing your tweets. Tweet me at Jonathan Davis, where the O is a 0. Email me at jdavis@jonathandaviswm. Listener, this has been the Booms and Bust Show. I've enjoyed it tremendously. I hope you have too. Please spread the message. Download the app on iTunes and subscribe to it, and then it will automatically go into your mobile device or indeed into your computer. Thanks for listening, and I'll see you again in due course. Enjoy your week.